Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Thursday, September 28, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. At the expense of sounding like a broken record, I'm going to sound like a broken record for a minute, and basically the market continues at least a little bit to grind higher. These SPDRs are up 0.1%. We remain above the 248.91. That's bullish. We're in a bullish pattern. We appear to be breaking out to new highs. What we do have is quarter end tomorrow. And that's always an important time because the mutual funds, the hedge funds, and all the other institutional sales arms, if you will, they certainly don't want to see the market go down into an end of the quarter. If they're having a decent quarter, they want to maintain that decent quarter. When people get their statements and their reports, their quarter end reports, they want it to look good. So whether or not that has anything to do with the last several days of activity or not remains, a mystery. However, I just wanted to point out that it is the end of quarter. And when you look back in history, at the end of quarters, we tend to float at least sideways to higher. Not all the time, but a lot of the time. So it's not surprising to me, and it won't be surprising to me if we see another day similar to what we've seen today, tomorrow being Friday. The volume will be extremely light. The volume was extremely light today. The SPDRs are right around 44 million shares, and we'll probably see something even lighter than that tomorrow. By Friday afternoon, we generally see the market kind of go to sleep from about 10:30, 11 o'clock on, and unless there's something substantial happening in the market, that'll most likely be the case one more time. So I'm not going to rehash the SPDRs. Everything I said yesterday and the days before remain the case. We're in a bullish stance. The market appears to want to break higher. We'll see if that's the case. We know our break points. 248.91 is the first level of trouble, and the second level where you really get the sell signal is 248.02, which is right around this gap window. Any close, daily close below that level, and that's actually a sell signal for the market. The IWM remains the strong horse. We had another update today in the IWM, and I want to point out something interesting, right? So yesterday's high was 247.86. Today's close is 247.85. Like I always say, that's not a coincidence. It's not an accident. That's the way the market works. It's almost like a tease. But nevertheless, the market's going higher. The IWM is going higher. We're up higher in the after hours. But the close of the daily or the regular session on the daily chart was right underneath yesterday's high. So the IWM, as my favorite leading indicator of the market, continues to pull higher, drive higher. It's not necessarily pulling the entire market with us. However, when you look at my two favorite leading indicators, they are higher, they are breaking out to new highs, and that is something that we need to take seriously and pay attention to. So I am paying very close attention to the IWM. Needless to say, as you all know, I am surprised that we did break out to new highs, but that is the case. Tomorrow's close is going to be very interesting in the IWM. It looks to me like they want to close it above this trend line. We'll see if that is the case tomorrow. The trend line, as you visually see it on the chart, is not necessarily an exact number or exact to the number. But when you look at the monthly chart, you get a picture of what I'm looking at. Connecting these lows, okay, these pivot low here, pivot low here, pivot low here, and here's where you have your trend line, and we are comfortably above that trend line. If we were to close up here tomorrow, that would be a close above the trend line, but we would need another month of confirmation above this month's close to really confirm a bona fide breakout. That's a long time to wait to see if that market's going to close above that trend line. But nevertheless, the rules are the rules, or at least they're my rules. But looking at the daily chart, weekly, monthly chart, there's no doubt about it. We are breaking out in the IWM, and that needs to be taken very seriously. When you look over at the transports, same routine. Another closing high with the transports today. This is a breakout to new highs. This is a very, very bullish chart in an uptrend. However, what I will tell you is both the IWM, and I didn't mention, by the way, let's go back to the IWM real quick. I just want to make mention of one thing, that this was yesterday, in my opinion, a signal of an exhaustion candle. We'll see what happens over the coming days, but that's on the daily chart, right? When you look at the weekly chart, for argument's sake, okay, that's not necessarily an exhaustion candle on the weekly chart. The volume is high this week, but it's not out of the ordinary, right? If the volume was up here, like we saw up at 300 plus million shares on this weekly candle here, that was not an exhaustion because that came from a pullback pattern. So that was the sign of another bullish move, or the beginning of another bullish move. Here, we're at highs on the chart, but we didn't see exhaustion type move on the weekly chart. So this is just exhaustion from a daily chart perspective. We can certainly pull back and consolidate and build energy for another move higher on the daily chart. So I want to make sure that we're all clear on that. The exhaustion candle, what I believe is an exhaustion candle, is only prevalent on the daily chart in the IWM. Going over to the transports, or back to the transports, we don't have any kind of exhaustion type volume on the transports. Exhaustion volume on the transports could be looked at as around 100 million shares. We have nothing like that. We have about half that much. So when we look at the transports, what we have to see right before our eyes is a breakout to new highs, a bullish chart, upsloping 20-period moving average. The 50-period moving average is beginning to turn up. This purple line is a 100 moving average, and that's turning up. So this is telling you that the market is bullish, remains bullish, and the moving averages are turning up, which is bullish in and of itself. But both these markets, the IWM and the transports, are short-term overbought on these daily charts. There's no two ways about it. But keep in mind that markets can always go a lot farther on the upside and a lot farther on the downside than most people believe that they can. So leading into quarter end, which is tomorrow, don't be surprised to see further buying pressure in the market, as these markets are likely to end the month and the quarter at their highs. I don't know that that's going to happen. That's not 100%. I'm just telling you what I believe to be the case just based on what I'm seeing here. It's more of an opinion than anything else. Okay, let's go over to, we'll take a look at the broker-dealer index, which has also been a strong horse, also breaking out to new highs. So you have the transports, the IWM, and the broker-dealer index all at and continuing to break out to new highs. This move, while we may continue to break out to new highs over the next several months, this move here on the daily chart is certainly unsustainable. It's going to have to pull back at some point in time, but we're looking for signals of a reversal in all these markets in order to say that a pullback is in the cards, because without that signal, markets can go a lot higher than people think and anticipate that they can. So we're not going to try and pick tops at new highs. It's a fool's game. It just doesn't work the majority of the time. When you look at the Qs, for example, we're not at new highs all of a sudden. So it's interesting that we do have a divergence in the triple Qs, or the tech sector. And that's interesting. It's not an end-all be-all. It's, again, part and parcel to the reason why I'm not in love with using the Qs or the NASDAQ as my market leading indicator. As you can see, it was leading on the upside, making new highs when other markets weren't, and now it's not making new highs when other markets are. So there is a divergence in the Qs, and we'll see what happens. But what's interesting to me is that this is a bearish pattern right below the 20-period moving average. We had a down move. Now we're making a bearish wedge pattern. We remain below the 20-period moving average. Under normal conditions, this pattern promotes another move in the downward direction. We'll see what happens over the coming days, but I'm paying attention. In fact, I'm paying very close attention to all these markets. I do find it interesting that we do have a divergence with the NASDAQ or the triple Qs. Just to compare and contrast, the NASDAQ composite, it doesn't look as weak as the triple Qs. We're now approaching the old highs from August 18th, and we did that yesterday. We made a run for it. We pulled back, and today we were up slightly. It was more of a flat day. So we'll see what happens, but we are above the 20-day moving average, as we're not on the Qs, but we are on the NASDAQ Composite. That's interesting. Can't make a whole lot out of it right now, but I'm watching very closely all these markets, so I just wanted to point that out. The last market we'll take a look at in the stock market world is the Philadelphia Semiconductor Index, and they look much like the NASDAQ Composite. Not the same, but they look similar. We're approaching the highs made in August, but we're not at new highs, which I think is interesting. So there is some divergence in the tech sector that we just need to pay a close attention to. Nothing more, nothing yet just now. There's way more markets breaking out than aren't. So I'm going with the majority rather than the minority. But I just wanted to point out that there is some level of weakness remaining in the tech sector. Going over to gold, we had a bit of a pause day in gold, up a couple of dollars. We're not going to make anything out of that. I think there's lower prices coming in the gold market. If we do continue down in gold, then the stopping point should be, at least from a temporary standpoint, should be 1262. That's the level I have my eye on. There's a gap fill over here. We'll see if the market wants to come down to that. You have your 200 period moving average sloping up into price. So even slightly below 1262, there's somewhat of a safety net down at 1255, and this is a moving target because it does edge up a little bit each and every day. If we edged higher in the gold market, you're going to find some overhead resistance right around 1297, coming in right where that 50 period moving average is currently. So there's your bracket. Your bracket right now is about 1297, maybe 1300. There's a gap up here, and the gap is 1301 spot 70. So your zone is 1301.02 down to 1262. That's really your bracket right now in the gold market. Silver had a very similar day to gold. Silver has downward pressure. We're below all the moving averages. But the pressure right now in gold and silver is really to the downside. I wouldn't be interested in silver until we got down to about the 1640 level, and we'll just put this right around 1640. That would be an area that you should have very, very good daily chart support for silver. Going over to the crude oil market. We did take a spike up to that level I discussed about, or in and about that level, which is this double top area here. When you look at the area, this double top is just above where price came to today. That area comes in at 53.13, and today's high, I'll just move the chart over if I can. Today's high comes in at 52.86. So I said that we would find a lot of overhead resistance up in this zone, but keep in mind we are putting in, at least so far, a bullish pattern. As long as we stay above the first level is the 200 period moving average, which we did come into back test today. But the real area is this green candle low, 50.39, pardon me. Any close below 50.39 would be a sell signal, most likely for the crude oil market. But as long as we stay above the 200 period moving average and continue to go sideways back and forth, then this market is building energy to make another run higher. And if that's the case, then the next stop would be 54, then 54.5, then 55. But remember, I said we didn't build enough energy yet, and I talked about this last night, that we didn't necessarily consolidate long enough yet to really get much higher. And you can see what happened. We did spike higher today, but we failed. And that was what was to be expected based on the fact that the market just didn't spend enough time consolidating. And remember, time is more important than price. The bond market continues to go lower. We finished slightly lower today, but we were lower earlier in the day and did bounce back. But the area that I would be interested in looking at the long side on this chart doesn't come into play till about 150.20. In this neighborhood, right around here where you have the double bottom area. So this double bottom comes in at 150.11. So anywhere in that area between 150.20 and 150.11 would be an area, and also happens to be the 200 period moving average is right smack in the middle of that. So that would be an area that we were likely to find a pretty fair amount of chart support in the bond market. And remember, we're not really talking about the bond market as much as I am talking about how to read this chart. And you read this chart right here by saying in this zone, right where the 200 period moving average is where you're likely to find chart support. Other than that, nothing's really changed from the bond market standpoint. And when we look at the dollar, we had a little bit of a pullback in the dollar. Now, the only way, in my opinion, that we get through this area that I say is important, right, up here, this double top area, the only way that we get above that is if we consolidate here for a period of time. How long is that going to take? It would really have to take around a week, in my opinion. So we had a little bit of a pullback today. If we consolidate like this for about a week in between the 50 moving average and where we are now, then that would maybe do the trick and we could possibly get through that area, but we would likely find some resistance at this 100-day moving average also. But until and unless we can close convincingly above that area of these pivot highs over here, and that comes in at 93 spot 83.84, then until and unless that happens, then I think there's still going to be downward pressure in the dollar. And with that, it's everything I wanted to discuss tonight. I'm going to wrap it here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.